Salesforce Inc. ticker symbol CRM is currently trading at $330 a share. Year to date, this stock is up 28%. And if we compare it to the S&P 500 over that same time, it is beating the market 28 to 26%. Over the last year, beating the market as well, 46 to 31, and over the last 5 years is up almost 100% to the market's 98. Is this the right time to buy Salesforce? That is the question we're going to be answering today. We're going to be looking at my automated stock valuation spreadsheet, seeing Salesforce's company financials, and then deciding whether or not it's buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So let's head into the sheet and type in CRM, not CMR, that's something completely different. And this will load up all the latest company financial data for Salesforce Inc. and we can have a comparison. So market cap of 314 billion, a P ratio of 57.43, which is a lot higher than the market average, which is currently around about 30.7. Earnings per share $5.57, and a beta of 1.29, meaning it is more volatile than the market. Analysts do say it is a buy with a target price of $347 a share. They do currently pay a dividend, 0.48%, meaning if you own the shares for a year, you get paid $1.58. They pay a 1.5 billion out in dividend, and that is very safe. 26% of the net income and only 13% of the free cash flow ratio. So if you want to if you want to get this dividend, buy before the 18th of December, and you will be paid if you own the stock, that is. So we have the details here, but let's have a look at the yearly breakdowns. Revenue, all-time highs, 36.5 billion, beating out the last, consistent growth. They've consistently broke their prior record each year. 5-year compound annual growth rate around 20%, but you can see it is growing and still growing in the trailing 12 months. Net income, is it a similar story? Yes, it is. 5.63 billion. So they've managed to generate more profit out of that revenue, and all-time highs once again. They had some dips in 22, 23, rebounded 24, and in the trailing 12 months up to all-time highs. Free cash flow. Yes, looks pretty similar. 11.46 billion. They are generating a lot of free cash flow, all-time highs. And if we do compare operating cash flow versus capex, which is obviously free cash flow, you can see that operating cash flow is growing, and surprisingly capex is down slightly. As you can see here, they have never really gone over, I would say that's probably over a billion, but they're up to about 10 and 11 billion in terms of operating cash flow. Shares outstanding, what are they doing? Well, there is some splits in here, but it looks like they were issuing more shares up until about 2023, and now they have started buying back the shares, so they're rewarding shareholders like that. So let's have a look at the discounted free cash flow model. It's a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So based on averages, it's currently undervalued at and should be at a fair price of around about $470 a share. So let's have a deeper look at these numbers and see if we agree. We're estimating around about 40 billion and 43 billion in terms of revenue. If we compare with what analysts are saying that we're a little bit on the bullish side, actually 38 and 41 billion. So we'll bring it down to that level. So we'll say about 4%. Sorry, I've completely forgotten those numbers. What was it? 38 and 41 billion. Jeez Louise. So we'll just up that. Okay, well, I suppose 4.5%. A little bit more bullish. $390 a share. Net income margins. See, I think these numbers are a bit of a blip. So we'll take an average of these last 2 years, which actually brings it up to about 13%. $500 a share. And this is why. Okay, so the net income free cash flow, what we'll do is we'll take an average of these 2 prior years, $160 a share, and yeah, see, there you go. Wow, $140 a share. And the reason for this is because the average of the free cash flow ratio in 2023 was 2,000%, so obviously brings it up. But if we take an average of these years here, in fact, we'll look at the trailing 12 months. We'll do 200%. $172 a share. So discounted free cash flow, everything was looking promising, but this is why you have to have a deeper look at the numbers here. You can't just look at a model and see if it is buy or sell. You need to look at the numbers and understand them, and that's what hopefully this sheet offers. So if you're interested, obviously check out the Patreon. Lower the price to $4 a month, a Christmas deal. Anyway, let's continue. Dividend discount model, sorry, we won't be looking at that. They've only started paying a dividend in 2024. So we will be not using this, but hopefully in the future. Next, Ben Graham formula for intrinsic value. It was created by the godfather of value investing, Ben Graham, and it looks at the expected growth rate, PE of a non-growth company, and comparing against bond yields, which the bond yield currently is 4.95%. And analysts are saying that Salesforce over the next year will be growing at around about, say, 22 to 10%. So even at the more bullish side, 20%, fair value of 150, which is pretty close to the discounted free cash flow model. So Ben Graham would not think it's a buy either. Finally, we are going to be looking at the comparable company model. This is a way of valuing stocks, looking at similar companies and similar industry sizes, and then comparing those ratios. The ratios being EV to revenue, EV to EBITDA, and PE. But also, we'll be looking at the revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, and Peter Lynch's price to earnings growth. So, if I just type in on Google comparable companies, I did have a list, but unfortunately I've closed it down. Salesforce Inc. comparable companies. We'll see what Seeking Alpha has to say. Yeah, Adobe is one I'm thinking of initially, or Adobe. Ticker symbol is ADBE. And what this will do is upload all the latest company financials for this. Supposedly SAP. And finally, we'll look at INTU. And this will load all the company financials data for all of these. So, Salesforce is the largest, 320 billion. The others are pretty close, 200 and 180 billion. Revenue, most revenue, highest revenue growth rate, highest EBITDA, highest profit. Not the middle of the pack profit margins, but still pretty good. Price to sales, second lowest. Price to book, lowest. Higher than the market averages though. Price to sales is around about 3.1, and price to book is around about 5.28. Peter Lynch's price to earnings growth. Ideally you want this under 1, but these are all higher than 1, and you can see that the lowest is 1.7, highest is 2.6, Salesforce being about in the middle. EV to revenue, second lowest. EV to EBITDA, second lowest. PE, interestingly, even though 57, still second lowest, and forward PE, second lowest as well. So based on these on the comparable company model, $350 a share, meaning it is just undervalued at the minute. So despite trading these high multiples, it is a buy according to the comparable company model, whereas the Ben Graham formula and the discounted free cash flow model put it somewhere in the 140s. Now, if we were to look at the stock price, obviously it is at all-time highs, hasn't been 140 since the start of 2023, and has gone on a 150% run since then. Right guys, thanks for watching. Please give a like on the video if you enjoy it, subscribe if you're not already, check out my Patreon, and I'll catch you guys next time.